The metamaterial stock has been the topic of many conversations as of late, and in today's video, we're going to look at its price action, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we should be mindful about which positions we pick, as well as their individual timings and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, the price action of Mmat or metamaterials has brought the stock to around $1.99 before stabilizing around $1.81. Metamaterials was having a decent month so far, and its price was able to increase by more than 40% in this challenging environment after the bottom was tested around May the 10th. The stock was also recently chosen as one of the fastest growing sustainable companies in Canada, which is yet another token of recognition on the company's potentials and social responsibilities going forward, as it manufactures next-gen equipment and thermoelectric generators. As far as the market is concerned, I believe that although Mmat is following the same trend as the rest of the tech sector, it's having relatively less selling pressure compared to many other titles. And this by itself is presenting some interesting opportunities for those looking for decent entries. From the long-term perspective, it's worth mentioning that metamaterials has been trading on a relatively long time compared to many other tech stocks, and that its baseline has remained on very similar levels over the past few years. Now, let's also take a look at the technicals of the stock. The trading volume of metamaterials has recently been 2.4 million shares, versus an average of 4.7 million shares. Over the previous 52-week period, the price fluctuated between $1.03 and $21.76. The trading volume is a metric that can tell you how many shares are being exchanged and whether there's a lot of activities and focus on the stock. It often gives you a first idea about its popularity. When we use it to compare it with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through current resistance levels. Even when the current volume is lower than average, it is an interesting indication because it may signify that a trend reversal may happen soon. The market cap of metamaterials is currently at around $536 million versus an enterprise value of $453 million. To put simply, the market cap is the fair market value of the company's assets based on the current sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost of the company that has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets that many growth companies may have is intangible, meaning they're not items or inventory that companies may use to generate income necessarily, but really they're the promises for future potentials, such as pledges for major contracts, management, blueprints, and other items of such kind. For startups, most of their valuations are based on intangibles, which can be valued in favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, but this doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and that it has only caught up with the reality ever since. As we compare the current price to the historical price fluctuations, the stock is 76% higher than the 1-month low, 76% higher than the 3-month low, and 76% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility is 134% versus a historical volatility of 93%. The put-call volume ratio is currently at 0.06. It's normal for many stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 2.4 thousand contracts a day versus the 30-day average of 4.5 thousands. In terms of open interest, the most recent volume of open interest has been 98,000 contracts versus the 30-day average of 87,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you premiums with an obligation to execute those rights if the counterparty chooses to do so. It's often said that you can evaluate the likely scenario based on the opposite of what the current ratio is. If there's a lot of put options, then there may be an uptrend on the move, or the reversal may happen if there's a lot of call options. The reasoning behind this is that most option contracts will expire worthless either way. In terms of its shareholder structure, institutional shareholders own about 25% of the outstanding shares. The biggest shareholders include SPDR, BlackRock, and Vanguard. It's relevant to understand the shareholder composition of the company, as this helps us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this, as many great titles are mostly held by retail as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 18% of the total float, with 65% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total float, with a significant chunk of the volume coming out of the dark pools, this may suggest that there are institutional positions taken to short the stock and there would be potentials for a short squeeze. My recommendation is to buy Mmat Materials now and to hold it for at least 6 to 12 months, and to sell it for at least 30% profit margin as an initial target, and then use this profit to stay for the long term if this is your plan. I would also recommend to commit between 1 to 3% of your portfolio in batches of 10 to 20% at a time, so that you can purchase more in further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.